Is the market priced to perfection? Meta dropped its earnings after the bell and it slid 12% on its Q2 guidance, signaling that despite a 4 to 5% pullback in the S&P 500, this market could be priced to perfection. So was the last 2 days of price action simply a bull trap, and do we go lower from here? Today, we're going to talk about that and the two other major drivers of volatility, PCE and GDP. Tomorrow we get GDP data, Friday is PCE, and we're going to discuss expectations and what normally happens to the S&P 500 around those data points. We'll talk about what happens if we come in hot, come in cool, or come in line. Also, we're going to talk about sector rotation, oil, and why this chart is one we need to keep an eye on. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe. We're trying to get 10K subscribers in May. Hit that notification bell as well and leave a like on this video. It's really good for the algorithm. Let's get into it. A very mixed day today here, guys. Let's look at technology, right? Look at semiconductors. We had Nvidia was down 3%, but then we had some other stocks kind of flat, and then some really green names. Texas Instruments up 5% on their earnings, and they helped some of these other producers, stuff like NXPI on semiconductor. Then we look at software application, stuff like Uber down 2% because of news on what Tesla is releasing with their ride-hailing app, and then Tesla up 12% when Amazon and other cyclical names, stuff like Home Depot, were down on the day. So, very mixed across all of these sectors. The big boys did put up pretty good days, Microsoft, Apple, Google at the very least. I think a lot of these names are running up into their earnings. Microsoft and Google report tomorrow. Consumer defensives, actually Pepsi, they were down yesterday, but up today about the same amount. So maybe the pessimism in Pepsi yesterday was dumbfounded. PG up on a green day, same here with Coca-Cola. All in all, a very mixed day of trade today though, guys. Look, there was no real trend that you could actually discern from this. I mean, look at the top: discretionary, staples, defensive sectors, rate sensitive sectors, cyclical sectors. Same thing here at the bottom: defensive sectors, cyclical sectors, rate sensitive sectors. There was no real leadership today, and we generally do see that in the bulk of earnings season because stocks can gap up, gap down based on guidance, based on earnings, based on numbers, based on sentiment. Generally get a very mixed day of trade. However, a couple of trends I guess you can consider. Number one, XLY. Let's just remove this from the tape, right? Because of Tesla, that's why it was up. Who really won the day? Staples, utilities, regional banks. Now we do know that the risk of trade right now, because regional banks are so heavily shorted by hedge funds, the risk on is to short. Risk off is to buy back those stock, and that's why you get this upbeat action here in regionals, which means that there's still risk off sentiment in the market based on regionals, based on utilities, based on staples. So the market is kind of positioning risk off into GDP, into PCE, and probably into Microsoft and Google's earnings, because some of these tech names are priced to perfection. We saw that with Meta today. We're going to get into their earnings a little later. Other than that, no real trend to take away from this, guys. We did see a bit of selling here during the early part of the day, and then around 12:30, most sectors kind of like caught a bottom, and then we did move higher into the day. But why did the market pretty much put out a flat day today? It was very, very simple, okay? Bond yields were actually rising. That did dampen market activity. We just had a 5-year bond auction, and demand was very average, especially leading up into QRA next week. You'd want to see kind of upbeat demand. Demand was average. And then I think the market is just a bit nervous. It's just trading ahead of the GDP and PCE prints over the next couple of days. When the market is going into prints that can be very uncertain and cause a lot of volatility, we tend to see the risk of price action that we did today with staples, utilities at the top, taking a bit of risk off with regional banks. But let's hop on the charts and talk about everything. Before we talk about the S&P 500, let's actually look at the broader market as a whole. The S&P 500 pretty much flat on the day, right? The RSP up 0.14%, so the broader market did gain. Look at the Nasdaq 100, the bigger boys, technology did gain as well. And then mid caps, same as the S&P 500, pretty much flat. However, small caps, SP 600, IWM did take it on the chin. They did lose today, and that's because of what happened, the yield situation. Yields actually did rise. This is after hours trades here for yields, but look at AGG, look at TLT, look at HYG. They did fall quite substantially on the day, and they're actually down in after hours trade as well. And the market just didn't like that. And then we saw stuff like the RTY down 0.4% on the day. So yields did dampen activity, the activity of higher beta. Now, something to note, this is the SPY right here. You can actually see we pretty much did finish flat on the day. However, the SPY coming under pressure in after hours due to some of the earnings we saw. Same with SPYG, the growth factor, and that had to do with Meta's earnings, but not just Meta. ServiceNow also reported earnings. Great earnings, by the way. The market just didn't like the guidance figure, and it is trading lower in the after hours. All in all, though, a very mixed day of trade. Looking at some of our other proxies, look at Bitcoin. I think this asset might actually be fairly valued. This price action is not really looking constructive for higher prices. I mean, we're putting in lower highs, an equal high right there, a lower high, I guess, at the same time putting in lows. Imagine if this was to like move down here, use as resistance. That's just conducive to lower price action. We look at something like gold holding up fairly well. After a big run like this, you would expect it to come down a little bit, and market finding value here at this 2300 level. Very much a similar situation for silver. The charts look pretty much exactly the same. The dollar did gain, and that did pressure stocks a tad. However, still down in aggregate from yesterday's trade. And then we look at something like crude, and again, that 80 to 88, 80 to $90 range continues to be the support range. And I think we're going to stay in that range until the next OPEC Plus meeting, which is in a couple of weeks, I believe. Now, looking at S&P 500. So firstly, a red bodied candle, but that's because we gapped up. We did finish flat on the day. Let's not forget that. However, we did gap up. We did trade lower, and the bulls did come in a very big way to actually support price at the 50-50 level right here. Now, the 50-50 level is actually the gamma flip zone. So the market did go ahead and buy at a very, very key support level. And we also held the 50-71, 50-70, 50-69 level right here, a very critical level. And I do believe as long as we stay above this 50-70 level, we buy dips, sell rips all the way to the 5100 area. However, it does get a bit mission critical. If we do fall below this area right here, the first line I would look at buying is this 50-27 area. If the market breaks that, I think we can then actually see lower price action, because then we'd actually put in another lower high, and then we can drift into this zone, and then it becomes really mission critical for the SPY. But as it is right now, we're in positive gamma, and we know what we do in positive gamma. We buy dips, sell rips to the call gamma resistance, and that is at 5100, and then the 50-50 area, which is this key zone right here. Let's just quickly hop on the 5-minute chart. I just want to zoom out and show you guys something. So the gamma flip zone right now is right here. Okay, the 50-50 zone. Let's actually change that to pink. That's the gamma flip zone. Look at the type of trade we had in this negative gamma environment, right? Look at the volatility we had, and then look at the type of trade we've had above the 50-50 zone. Yeah, we had a little bit of volatility here. I think that mostly had to do with the gap up, but fairly compressed trading right here. This is like a very tight zone we're trading in, and that's generally speaking what happens in negative gamma versus positive gamma, right? In negative gamma, you can have like very erratic movements to the upside and downside, but in positive gamma, it's very muted. You have very compressed volatility. But looking at today's trade, we did gap up, put in a high right here, and then the bears came in a very big way, but the bulls held the line at a very critical level and took us all the way back up. Do consider we did put in a lower high, but we also did put in a higher low. So a lot of indecisive action here on the day. And then the 0 DTE hedges rolled off, and this is where we finished on the day, right above the 50-70 zone. But going back here, my expectation for the rest of the week, if we stay above the 50-70 zone, right, I think we just buy dips, sell rips all the way to 5100, 50-40. If we do get below the 70 zone, look to this 50-25 as the first leg of support. If we do get below here, I'll give you guys an update as to what's going to happen. But then it does look very grim for the S&P 500, and then we might see the bears come back. However, I am bullish, and I remain convicted to the 5100 area, the call gamma resistance, and the 5150 area, this right here. So earnings today, I haven't seen what IBM did. Chipotle is up 5% after hours. I think they really had a great quarter. Didn't see what T-Mobile did. I think Ford had a double beat. Boeing, I think Boeing was very weird. I think they actually lost money on the quarter, and then we're going to talk in depth about Meta. This report, just looking at the figures, the fundamentals, was great. EPS 4.71 versus 4.32 on revenues of 36.4 billion versus 36.1, and daily active users 3.4 billion. Guys, every single day, 40% of the world's population uses a Meta product. That is scale. That is crazy. The installed user base, absolutely wild. It's rivaling something like Apple. However, the stock was down 10%. I saw even up to as close as 12% in the after hours on its Q2 guidance. It guided for 36.5 to $39 billion. The street's expectation was 38.24. So the top end of guidance did beat the street's expectations. The problem is the range of this guidance, right? This is a big range, 36.5 to 39. That's a 10% difference between the low end and the top end. And the market just didn't like the width of the guidance. Normally Meta gives quite tight guidance figures. The market didn't like that, and that's signaling to the market that there could be some near-term problems with the financials, with something in the company. Maybe they're going to spend a bit more on capex with Reality Labs. I didn't really like what I saw with Reality Labs. They burnt $3.5 billion this quarter on Reality Labs. I don't want to see that. That was part of the reason why Meta actually sold off in 2022. They were spending a lot of money on their VR, metaverse type of stuff, and the street really heavily sold Meta on just poor spending, poor management, and I don't want to see the company go back to that. However, we look at everything in aggregate. EPS, revenue, daily active users, the fundamentals of the company are good. In fact, every single metric improved in Meta. Look at the daily active users. Look at ad impressions up 20% year over year. Look at the revenue figure. Look at operating margin. Look at free cash flow margin. Look at EPS, right? Look at capex. Meta beat on everything in this earnings report. The fundamentals of the company have never ever been better, but got sold off on that guidance. And I also think the Reality Labs, the market doesn't want to see you blowing $3.5 billion of money on Reality Labs. We don't want to go back to the 2022 times, okay? And that's why Meta was down, 10, 12, 9% in the after hours. Now guys, let's talk earnings. This is the S&P 500 blended earnings scorecard. We're going to go over these every single day over the next couple of weeks, just so we get the full picture, the most updated picture of where we stand with S&P 500 earnings, excluding energy, and then this weird Bristol-Myers Squibb adjustment that we have to take into account because it is playing a big portion here in earnings. Now, right now, the S&P 500 is reporting 3.4% in revenues, 2.9% growth in earnings. Excluding energy, it's 5.6%, and then the BMY adjustment, 6% here. By the way, this BMY adjustment actually includes the energy section. So it's just the BMY adjustment is really having a big impact on overall S&P 500. So that being said, revenue coming in line, excluding energy, coming in slightly better than expected. And earnings so far are looking really, really good. I mean, this quarter isn't the inflection point. The real inflection point is the second quarter, 2024. And if we get great earnings this quarter, that's really, really good. Now let's actually have a look at EPS growth here for small caps. So this is the S&P 600 and then the S&P 500. And this is where we are right now for the S&P 600. So they are expected to report just negative earnings. We're probably looking at anywhere from -2 to 3% earnings growth here in the S&P 600. But then we see a huge uptick in earnings in a very, very big way. They're going to post equal earnings here in the second quarter of 2024 to the S&P 500. Then they're actually going to report higher earnings in the third quarter as well as the fourth quarter. Then the fourth quarter is going to be the peak. It's going to be well above 20% earnings growth, and then we should see earnings decelerate. However, do take into consideration the S&P 600 is still going to be reporting 20% earnings growth in the first quarter of 2025, just below 20% in the second and third, as well as the fourth quarter of 2025. So guys, I do believe that this is a great time to get into small caps right now for what could be a fantastic 2025. So getting in right here where valuations are still very, very reasonable at 13 times, maybe 12 times if you buy the IWM, because it's going to be a fantastic year in 2025. But these earnings right here do have to materialize. And also the fourth quarter 2025 earnings for S&P 600 is looking like well above 10% for the entire year. We're looking very close to 15% here. So, guys, in this environment where earnings are growing, you want to have exposure to equities and, buy large caps, buy small caps, maybe even buy mid caps. I don't see why their earnings would be any different. Now let's talk about sentiment, guys. So fear is running the show. Despite all of the price action we've seen, we're still in fear territory. However, if we do continue rallying and we do continue higher, we are going to move into this neutral territory, into this greed territory. And, just a month ago, we were in greed and we had a nice little reset here from the market. We had a 5% garden variety pullback. It's going to be volatility on the way back to all-time highs. However, it was a neat little pullback. Earnings come in, stocks got cheaper on a price level basis, stocks got cheaper on an earnings level basis, and now we can rally to even higher highs in the S&P 500. Now let's actually talk about PCE, because that's the one thing that can bring volatility this week, especially if we get a hot number. Now, this is some Goldman Sachs data. I'm going to read everything here for you. Very interesting stuff on why they believe PCE is actually going to come in cool. So they pretty much go on to say why core PCE inflation rose in Q1 and will fall for the rest of the year, a category level perspective. After falling to a 1.9% average monthly annualized pace in 2023 second half, core PCE inflation reaccelerated to a 4% average monthly annualized pace in 2024 Q1 based on our estimates of the March print. We look at the categories that drove this reacceleration and assess the outlook for core inflation through the rest of the year. In Q1, consumer electronic prices increased at a 21.9% average monthly annualized rate, boosting core inflation by 6.8 basis points per month, not annualized, relative to 2023 second half, the largest quarterly increase since the data began in 1959, likely due to the reversal of larger than usual end-of-year promotions that drove down prices in Q4 2023. The financial services component also accelerated to a 10.1% average monthly annualized rate, worth 4.5 basis points in the second half of 2023, reflecting the mechanical boost from rising equity prices to financial services prices. Healthcare services inflation ran hot in Q1, worth 2.4 basis points versus second half 2023, because price catch-up to the pandemic cost surge occurs disproportionately at the start of the year. Very interesting. Foreign travel also picked up as wholesale jet fuel prices increased while the dollar remained slightly weak. So all of these things, financial services component, right, healthcare cost, rising equity prices, as well as these seasonal adjustments allowed core inflation and inflation as a whole to come in pretty hot, not just in the last month, but in the last quarter year of 2024. Looking ahead, this is what matters. We expect the sequential pace of core PCE to slow from 0.33% on average in Q1 to 0.18% on average over the rest of the year, mostly reflecting softer consumer electronics, financial services, and healthcare services inflation. Recent dollar strength should weigh on foreign travel prices going forward, and we expect housing to be an ongoing source of disinflationary pressure this year and next year. Our forecast implies that the average monthly annualized pace of core PCE inflation will return to 2.2% over the next 3 quarters, leaving the year-on-year rate to 2.6% in December 2024. Very, very interesting. So both are expecting from here on out at least a 0.18 to 0.3% inflation growth, and probably closer to this level right here of 0.18% for core PCE inflation, which is really, really good. Now, I showed you this chart yesterday, and they expect housing to continue to be disinflationary in 2024, 2025. This is their forecast, and we're going to see a steep drop in the June-July area here in 2024. Now, at the same time, this is very interesting data right here, because they don't speak on oil prices, and I thought I'd put my input into how oil could affect PCE. The rise in oil prices only implies modest upside to core inflation, because even though they do remove energy prices from the core inflation figure, there's still flow-on effects that you just can't get rid of, right? And let's say someone makes candles and he ships his candles from Austin, Texas to New York City. Baked into the price of those candles is the cost of transport. So it's always flow-on. So you can see here that the headline, because of the 10% increase in oil we've seen in the last couple of months, is actually going to increase quite substantially. However, on the core level, it's only going to improve by about 3 to 4 basis points here. So it's going to have a very, very modest upside to core inflation. Upside nonetheless, but I don't think that the rise in energy prices will actually matter for core inflation. I think what's really going to matter is a lot of what both has said right here in this paragraph. Now, looking at some PCE data, let's say PCE does come in cool. What can we expect? So let's actually use December 2023 print, which was released on the 1st of January, right? So we can actually see we were expecting a 3% core PCE release. We got 2.9%. Into that print, we were down 0.1% of the day. And then the day after the release, you could actually see a return of 0.8%. 5 days later, 1.4%. 1 month later, 4.2%. We can see a very similar situation here in November 2023 with the data released on the 22nd of December. Estimate was 3.3. We came in at 3.2. That's a cool PCE number. Into the print, we rallied 1%. 1 day after 0.4, 5 days after negative 0.3, and then 1 month later 2.9%. So if we do get a cool number, we do want to be in equity exposure because we can actually get quite amazing returns 1 month after. However, when we get a hot number like we did last month, 1 day action return negative 0.2%, 5 days later, -1%, 1 month later, -4.6%. So a lot is going to depend on this print. I do think it's going to come in cool because we're going to see continued disinflationary pressure in shelter. Oil is going to have a modest upside to the PCE number, and a lot of the hot numbers we saw in PCE this quarter actually had to do with seasonal adjustments that we thought would be gone by March, but it just went an extra month. Do I think we're going to get a cool print? I don't think so. I think we're just going to get something that's in line and the market's going to travel along nicely. But if we do get a cool print, do expect a modest upside, and if it is hot, that's not going to help the market at all, and expect yields to spike, gold to spike, and equities to take the brunt of it. Looking at the JEX chart, not much has changed, guys, apart from the gamma flip zone being here at the 50-50. That's pretty much it. I mean, still elevated amounts of negative gamma, but a lot less than what it was a couple of days ago. 51 is the core resistance, 4900 is the put support. And really the only thing you want to look out for is if we go ahead, break above the gamma flip, hit the 5100 area, what happens to the core resistance strike? Does it move up? If it does, that's bullish. If it doesn't, it probably means we just balance around this area. If we are below the negative gamma, I would look at the 4900 level, but we have bounced quite significantly off these levels and actually rallied through despite all of this negative gamma here in the tape. So I do think we're probably going to go higher. I do think we put a short-term bottom in the market. It's not to say that we won't get volatility. We definitely will, and we can pull back to some serious levels. However, I think we've put in a short-term bottom. It's going to be volatility on the way, but we are going to go higher. And the first target here is the 5100 area. Guys, let's look at some charts. This is the swing breadth thrust, also known as the ZBT. So it's essentially the 10-day exponential moving average of NYSE advances divided by the advances and decliners combined. And what essentially it gives you is like a reading between this number and this number, and this right here is oversold, this right here is overbought. And pretty much if this price moves from the overbought to the oversold condition in less than 10 trading days, so pretty much 2 weeks of trade, you get something called a ZBT, a swing breadth thrust. And it just means you've had vicious forward momentum in breadth, and normally the forward returns are quite exponential. We had two last year in 2023, right here in March and right at the October lows, and the returns have been exceptional in both cases, both in total returns as well as to the highs, as you can see. Now here is the data for S&P 500 returns when there's a ZBT, and you can see that 5 days later you normally get to quite positive returns, 1.1%, 10 days later 1.9%, 21 days later, so 1 month, 4.8%, and you get very linear returns. Very rare you actually ever get a pullback 6 months, 12 months later. The only time was in 2008, and that was his own bag of cats. And you could see at 252 days later, 1 year, you normally get average return 22.9%, 93% of the time positive. And these are high quality statistics. And these thrusts are very, very rare. However, they are highly, highly accurate, and we are very close to making one. We actually still have about 6 days to go ahead and hit this top line right here, and I will keep you guys updated to see if we hit another ZBT thrust in 2024. Now looking at the risk on, risk off indicator, this is the long-term version, and we actually pulled back in a very material way here in this 5% pullback we had in the S&P 500, but we have since bounced off the 0 line, and this is very, very healthy. Bulls held the support line, we didn't dip below it, and it means it's still a risk on environment for longer term plays, and this was actually a great zone to get into. And even if we do go lower, I do think that the support we're seeing here with the ZBT and just a general enthusiasm to buy on a pullback is actually really healthy for the market, and that just tells us that we are probably going higher, and any short-term weakness is nothing but that, just short-term weakness. Now looking at breadth indicators, right? Yesterday I showed you this chart and I said 4 or 5 days ago, which was 3-4 days ago yesterday, breadth momentum here in the lows had actually peaked, and what we really wanted to start seeing is breadth momentum pick up in 1 month highs, 3 month highs, and then 1 month lows, 3 month lows start to deteriorate. And that's exactly what we're seeing across the board in the S&P 500, mid caps as well as small caps. You can see that 1 month highs in particular and 3 month highs, we're seeing a little bit of positive breadth momentum come into the market, with this negative breadth momentum deteriorating. That's exactly what you want to see. And what we do want to see now is continuation of this, particularly here in S&P 500 large caps, because they are the market movers. So we do want to see continuation of very, very solid breadth. And that would mean that this 5% pullback, the lows are probably put in, and then we can rally to all-time highs. And you do have to understand, a 5% pullback in price that coincides with earnings season is actually also a pullback on an earnings level basis, because now the market prices in the next quarter of earnings and stocks become cheap on an earnings basis. they're cheap on a price basis, and it sort of works twofold, if that makes any sense. Looking at further breadth metrics, percentage of stocks at 10-day lows, 1-month lows, 3-month lows, you can actually see that these have been deteriorating in a very substantial way, and that's what you want to see, guys. And we sort of peaked right here. It was sort of after this massive red candle, I think, on the CPI print. That was the peak in stocks making lows, and then from there we've seen drastic improvements. Percentage of stocks at their 200-day moving average for the S&P 500, 400, and 600. And you have to understand that if you look at these longer term breadth metrics, this is for like what investors look at. This is probably like what long-term fund managers are looking at. These metrics were largely unchanged by this pullback, and that's why, I say every 5% you want to buy the dip very aggressively. Markets pull back 5%, then 10%, then 15%. You want to buy the dip at each increment. When you have a huge majority of stocks above their 200 daily moving average, normally any pullbacks we do see tend to be the garden variety type of 5 to 10%, and you can often very quickly just miss the dip, and then you're sitting on your hands, and then the next one is only 3 months down the line after the index has rallied another 10%. Data in the week ahead, guys. So for Thursday, we got this GDP annualized for Q1. We are expecting 2.5% in this print right here, and then the big one, we got PCE month over month, year over year, core and headline, and the expectation there is for both the month over month on core and headline to come in at 0.3, as well as the year over year and core, as well as the headline year over year and core figures to come in at 2.6 here, as you can see. So if we get anything above these numbers, it's going to be a hot figure, and we will see volatility. Other data points, we do get pending home sales tomorrow, initial jobless claims as well, and then consumer sentiment here on Friday. So some very critical data points, as well as Microsoft and Google earnings tomorrow, to be prepared for a lot of volatility, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.